to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where Treasury professionals learn and share the information that matters most.
Hello and a warm welcome to the Open Treasury podcast from CTMfile. I am Pushpendra Mehta, Executive Writer for CTMfile, and I have with me Craig Jeffery, Managing Partner, Strategic Treasurer. Welcome back to the Open Treasury podcast, Craig.
It's good to talk to you again, Push.
For the benefit of our CTMfile audience, we will begin our conversation by discussing the 7th topic and the 8th article in a series on leading practices in corporate treasury published on CTMfile. This article is on risk management, and I think this topic couldn't have been published or discussed at a more appropriate time given the uncertain business and economic environment confronting treasurers today. Craig, as you know, the modern treasurer is expected to have a thorough understanding of a variety of risks and how these individual risk components can affect the organization's strategy, cash flow, reputation, branding, growth, and value. New risks and demands have also come to the fore, including the COVID-19 pandemic, the Russia-Ukraine war, the global supply chain snarls, cyber attacks on supplier networks, environmental, social, and governance pressures, and the growing threat of a global food crisis. In the light of these risks and vulnerabilities, Treasury will have to raise its game to overcome the risk management challenges they are facing right now and will face in the future. Craig, there are some themes that stand out in the article, and while these may vary or differ depending upon the location, size, and complexity of a business's operations, my first question to you is about an important facet of risk management, which is differentiating between risk tolerance and risk capacity. Often used as a synonym for risk appetite, risk tolerance in practice is different and is considered a lower level of risk than appetite. Can you talk us through some of the critical differences between risk capacity and risk tolerance?
Certainly. You know, when we think about the overall risk framework that an organization has, hopefully this is formally defined. If not, it may be informally understood. This covers a number of areas, including the ones you mentioned: risk capacity, risk appetite, risk tolerance. And when you think about, what is the organization trying to do with their risk management framework and the risk management practices, typically for most normal organizations, it's to reduce the level of risk they have, to bring it in line with their risk tolerance, what they're willing to bear, what they're truly willing to bear. And so this is removing, excess items, issues that would fall beyond their comfort level, that may also fall beyond their capacity level. So when we think about that broad topic, from the top, it's a board level issue of what type of risks do you want to take in. That influences what business you're in and how you manage that. So we'll dispense with some of those broader topics. But to your question about what's the difference between risk capacity, risk appetite, and risk tolerance. So risk capacity is what is the level of risk or exposure that your organization can take before you run into an issue. The issue might be a liquidity situation. It might be a loss of revenue or a certain level of loss that the organization cannot withstand. Maybe can't withstand it from a solvency perspective, or perhaps can't accept that from the perspective of the owners. Nobody will invest in the firm, or it's too much risk to take for the yield that exists. So there's a capacity level that could have a couple different definitions, but that tends to be a larger or broader level of risk. When we look at risk appetite, this is the difference between what people say and what they are willing to take. So appetite might be, hey, we're willing to bear this much loss. This is the business we're in. But if you get to that level, people will be very upset. They will not feel comfortable. They will have a margin or something discounted off of that, which is really the level of risk that the organization will tolerate. So if you say, we're willing to accept a $100 million loss, That may be on paper, but really their tolerance is anything over 80 million, for example, with commodity prices or whatever the particular risk is what they're willing to bear. I think it's really important that we fine-tune the appetite down to the actual tolerance. Being honest about it, in discussions is not really what the issue is. The issue is how will people react? And I think it's fair to state those different elements and put numbers on them to say, here's what we think our risk appetite is, but we really won't tolerate more than this. We will take more actions if we get to this particular level. And so this idea of capacity being a broader number should be defined by perhaps type of risk or in total. The appetite should be stated, as well as particularly the tolerance. What will the organization tolerate? And by stating those in different ways, that helps the organization to say, here are the numbers that we care about, a line in the sand, so to speak. And the reason they're in the sand is these will change over time. The organization grows, the organization diversifies, they might be more accepting of some risks, they might have greater capacity and therefore greater tolerance for different levels of swing in terms of what their performance is. So this is important for the organization to understand it and to be reminded of this on a relatively regular basis. But those are the key distinctions. What the organization really will tolerate before they get mad at people. And there's lots of stories about people getting mad at treasurers, even though they cut the risk levels even within the tolerance level. That can sometimes be a challenge.
Craig, the next question may seem commonplace, but sometimes the obvious is what is condoned or ignored. It is said that not everyone looks at risk the same way. Individuals in different functions frequently view risks and risk levels differently. You have mentioned that risk is in the eye of the beholder. From a risk management perspective, why is it important for treasurers to bear in mind that risk perceptions are different?
Well, yeah, part of risk management is making sure the organization understands what you're doing, why you're doing it, the purpose of your risk management program. The difference in the eye of the beholder may also be risk management is different in the eye of the type of company or organization. A hedge fund has a very different risk parameter. And then their business of taking bets on commodity price volatility or foreign exchange shift. That's their business. Their business is taking bets on certain types of disruptions or dislocations in the market. So that's their business. Whereas most corporations, public entities, government entities, their goal is to reduce the risk exposure they have and bring it in line with their risk tolerance, what they're willing to bear. And to do that in different ways, whether it's with natural hedges that one business offsets the other, and so you've reduced your risk by having other types of businesses, whether it's with financial instruments, a forward, an option, what have you, some way of mitigating or bringing that risk down at the margins or at the edges. Those are all effective ways of doing that. But the eye of the beholder can be very different based on the type of organization. But for most, I'll say traditional corporations, there are certain elements and certain aspects of their business that they're in that business. That's a risk that they take on inherently by being there. And there's other aspects of business that they need to manage that risk. And so what's acceptable to live with, what needs to be managed can be different from one organization to another beyond the I'm in a hedge fund versus I'm in a corporate or a public entity.
Great. Now, the next question is, to my mind, an important question, particularly because it discusses the purpose of risk management and the purpose of hedging, and it connects with something that you mentioned in your book that I thought was very interesting. So, as we know, the purpose of risk management is reconciling a company's risk exposures in line with its risk appetite, that is, decreasing exposures into the realm of what the company is capable of accepting as a loss. Similarly, the purpose of hedging is the mitigation of risk by bringing it within an organization's risk tolerance, not necessarily eliminating the risk completely. In connection with the purpose of risk management and hedging, a statement in the article, which you will also find in the chapter 10 of your book, The Strategic Treasurer, A Partnership for Corporate Growth, you stated that don't cheer for your hedges. Can you explain why a strategic treasurer should focus on doing their job with no cheers from the executive grandstands coming their way?
David Stowe and I had many, many conversations about this, and he was with our firm for quite some time. He's now with Coca-Cola. But this idea of don't cheer for your hedges and don't jeer at your hedges, both cheering and jeering, doesn't make sense for most regular corporations. I mean, your goal for your hedges is to reduce your volatility. It's to provide you a level of insurance against certain types of extreme activity that you don't want to bear. You're willing to pay the premium to remove that. Let's think about that for a few moments. If you have an exposure, maybe it's to interest rate or commodity prices, if things move in your favor and you didn't hedge, right? You held an asset or an exposure. You had an exposure. You were long in a particular asset. You had a ton of steel or whatever. You had a ton of steel. The price moved up. You were long in steel, and so that price moving up, you didn't hedge it, and so therefore you gained money on your holdings, not because it was some grand design, but because it happened. If you're short and you needed a lot of steel to complete particular transactions, or you're building something, and the price moved against you, and you may have already had committed sale price. Now your underlying raw materials or commodity price is going to be a negative impact to you. And so you bore that risk either way. You didn't hedge, you took and accepted that risk. To the extent that, whatever your exposure is to interest rates going up or down, the price of commodities going up or down, interest rates, foreign exchange, currency pairs moving against you or for you, really is somewhat irrelevant in the general scheme of things. You want to reduce those risks. Now, if you have an exposure, let's say your exposure is 100 units, you typically don't hedge 100%, and you rarely would hedge over. Let's say you're buying something in England and you have an exposure of $100 million to GBP, to pound sterling for the price, and you let that ride, and then when you go to pay for it, instead of it costing 138 million US, you end up having to pay 145 million US because the price moved against you. You have a certain underlying exposure. You don't want to cheer for your hedge to make money, because typically you're hedging less than 100% of the value. If your hedge makes money and it's less than 100% of the value, you're losing 100% of your underlying exposure and only recovering, let's say, if you did 50% hedge, so your hedge made money at a 50% rate and your underlying exposure lost money at 100%. That's not really very effective. If you're overhedged, you're probably not a regular corporate treasurer, because now you're entering into speculative territory. You're making a bet on prices moving in a certain direction over and above what you're exposed to. And that's it. And what I mean by that is intentionally ahead of time to do that. And since we're not in a speculative position, normally we don't want our hedges to make money. I mentioned jeering. I mentioned some other aspects of that. But in terms of jeering, you don't want your hedges to necessarily lose money either. That's not the purpose of them. It's not for cheering or jeering. It's not like your favorite sports team. You want to win. You're putting it there as insurance coverage. You don't cheer because, hey, I didn't use my insurance coverage. You don't jeer at your insurance coverage and say, man, that was terrible. We didn't get to use you for coverage at all. We just lost money on that. We would have done better without insurance. That type of mentality seems to be well understood, that doesn't make sense. You have insurance to protect you against something that might be catastrophic or outside of certain bounds. To the same extent, in some ways, that's what you're doing with your financial hedges. You're trying to bring it in line with your appetite. So you don't want them to lose or make money. Sometimes in a competitive situation, you are seeing what others are doing. They may be bearing 85% of the loss or 80% of the loss, and your perspective caused you to hedge 50%. Well, if things move negatively and your hedges make money and you're more hedged than your competitors, you may be doing better against them. You may now have some price advantages compared to others. So there's some other factors in there that play into those discussions. more deeply. But this idea of don't cheer and don't jeer. And Push, I know we've had some conversations. Sometimes there's treasurers who explain these things. What's the purpose of the hedge? It's to bring our risk in line with our risk tolerance. Now, other people, you'll hear this will happen, even if you're training and talking through these items, everyone agrees to it. Someone gets up and says, we would have done better if we hadn't put on those financial instruments. We lost money with them. That was a lot of money. We would have done significantly better. We had a cost, and we would have done significantly better not putting on those hedges. And there's quite a few people who are like, yeah, that's right. We would have done better. Maybe we shouldn't do this risk management program. And that's very short-sighted. It's very dangerous. And so that is a lot of the reason why this idea of, you have to continually train and educate the rest of the organization on what's the purpose of risk management. So don't cheer, don't jeer. You're basically trying to make sure you have alignment between your exposures and your risk tolerance, that those things are brought into alignment.
The next question that needs your valued perspective is about realizing the law of unintended consequences. Treasurers know that corporations, customers, counterparties, and suppliers are increasingly interdependent and interconnected along the entire value chain, and so are the risks and vulnerabilities. That means that a local risk can turn into a global one, and a disruption in one location or region can spread out quickly to many more regions, as we have witnessed during the pandemic and the Russian invasion of Ukraine. As corporations expand globally, value chains have grown in length and complexity. Companies have successfully implemented a lean global model of manufacturing, achieved through improvements in inventory levels, on-time and full deliveries, and shorter lead times. However, these operating model choices sometimes led to unintended consequences, unintentionally creating more problems than they solved, because they were not calibrated to risk exposures. Craig, why is it important for treasurers to realize the potential for unintended consequences? And can you give an example or two of how awareness of these unintended consequences can be leveraged to an organization's benefit?
I'll begin with a story. This idea of unintended consequences. Just because you can't think of something ahead of time doesn't mean that it really is unexpected or that you shouldn't account for something. And you can see this in like your personal budgeting. You may know like, oh, I've got my personal budget for what I need to spend on my house, and then, your water heater breaks or something else happens. You don't know what's going to break in any particular period of time, but you do know something's going to happen, and whether the amount is $4,000, 10,000 or whatever, there's some number that will happen every year. It might be more than that, but there's going to be something that you didn't plan, just because the mean time between failure of devices or floods or insects, whatever. There's things that they're going to come about. So you have to plan for something, but you don't know what goes on. But I'll give an example of these unintended consequences and unexpected items. From a personal example, we had a large van. We were in a remote area at a camping location, and there was about a mile dirt road, and it was near the Everglades. One side there was a kind of a little bit of a swampy field. The other side was a legitimate swamp, and then maybe 15 feet off of the start of the swamp, there was barbed wire fence sticking up through the water. And we were driving back, and I had my daughter. She was just semi-lap. I was letting her drive on this dirt road because I had to go open the gate for someone else to come in. Nobody used that road. It was a mile straight. It was 2 cars wide. And, this was a safe time to do things. I was driving down the road, and I don't know if I was going 35 miles an hour or 40 miles an hour. Let's say that would be about 60 or 70 kilometers an hour, because there's no place to go. There's nothing that could go on. So what could go wrong? Nothing could go wrong. Having your daughter steer the car when she's on your lap. Well, now I don't trust anything anywhere, because what was going on in her mind, she was like, okay, this is cool. I'm driving down the road. What happens if I whip the steering wheel in one direction and then whip it back? Well, if you do that, you can put it in a nice fishtail very quickly, which caused me to nearly lose control of certain functions, and all of a sudden go from this is very fun to we're going to plunge into a swamp. And I wasn't worried about the alligators, but plunging your vehicle into a swamp. You can get hurt. You ruin your vehicle. How do you pull it out? I mean, there's all those things that flash through your mind. Well, was able to control the fishtail and keep it on the road, and learned, no, you don't expect that everything's going to be fine, or think that nobody would have expected this or that to occur. That was one of those terrifying moments that we lived and weren't damaged, to learn from that. And so that's a mindset I take into place. And, Nicholas Taleb with his Black Swan book, and I know you've read that and you've quoted that. And there's these things we don't expect certain things to happen. We don't expect a swan to be black. Well, there are black swans. You just didn't know that. And so when you think about this distribution curve that might have really, really long tails going out very far on the ends, or maybe very narrow, and maybe one side has some curve, we tend not to think about that. We tend to think of the expected value. And so that's some of the mindset behind that. But to your question about unintended consequences, there's unintended consequences of not understanding what the risks are, unintended consequences of not communicating, competing activities resulting in unintended consequences, which might be more cost than you need. So one example might be everybody has their own responsibility for budget. People in different regions do their own hedging to reduce their exposure because they're optimizing it from their world. And then at a corporate level, maybe you're doing the same thing, not necessarily realizing that others are doing some sub-hedging. And so this idea of everyone's working to optimize their own performance, and by everyone optimizing their own performance, you've sub-optimized the whole of the organization. You spent more money on different financial instruments to do the hedging. You might not have the level of cover exposure you wanted. You may have some things working against each other. You may be multiple times covered, and now you're in a speculative position. So that's an example of unintended consequences. Not communicating well, not having good visibility, not communicating well are very, very common situations, whether it's FX or other types of hedging. The other is whether it's putting the financial instruments in, or it might be other people are doing certain types of trades or activities. They may be optimizing something other than financial risk. They may be managing pricing risk. And I know we've had conversations on the working capital side where someone does a big deal to buy stuff because they're concerned about price or lack of certain materials. I have a good friend who bought a lot of HVAC equipment for his business and other equipment that they need to have more reserves because of concerns about stainless steel, availability of resources due to production cycles. And so he acquired quite a bit more. That worked out very well because things moved in the direction he had expected. He had competitors trying to buy material, but other people do that expecting there's going to be, the housing boom's going to continue. And they've bought what was 3 months worth of supply, and it really turned out to be a year supply. And so now they have this whole risk of all this cash is tied up in inventory, or they entered into contracts that committed the firm to pay for certain things in perhaps foreign currency. So there's lots of examples about unintended consequences of not communicating, consequences of being isolated in what we do and not expecting something to be different. So we have to be more skeptical that everything's going to continue as it has for all time. We have to be skeptical when people say, well, this wouldn't happen because this regulation or this activity was put in place. It may not occur exactly. The negative situation may not happen exactly as it unfolded the last time, but there's going to be negative situations, maybe in different ways. And so, planning and being more suspicious, and don't let your daughter or your son sit on your lap when you're driving down a dirt road where they can yank the steering wheel and scare you half to death.
Hilarious as well as very insightful. Craig, can I ask you a follow-up question? I heard you use the word communicate, which to my mind, across the article and across we've discussed, that one word you said, communicate effectively. How important is communications or communicating effectively? Because you mentioned somewhere that not every organization is risk management ready, and some may not have a robust risk management framework for that matter. And then, risk management is also working with people at the end of the day. So can you talk through that?
Yeah, I mean, communicating effectively, I don't think there's a person in the world who would argue against that. I think the challenge is, how do you do that? How do you know what to communicate? And from a risk management perspective, there's going to be different people in the organization who have a risk management mentality for certain things. Someone who's in charge of risk management from a safety perspective sees accidents, slips and falls everywhere they go. They see someone walking around without a heel on their shoe, knowing they're going to climb a ladder, and they're already seeing the claims of what's going to happen because they have that mindset. And until you have seen that on YouTube or somewhere else, you're like, oh, that's why they have heels on shoes, and they require that on, et cetera, for this type of environment. So everyone has some view of risk management, or most people have some view of risk management. And the idea is, on the financial risk management side, is you have to have the rest of the organization understand what you're trying to do, especially where they have an area of influence. They can act or do something that could work against what the organization's trying to do. Communication is vital because it's like, hey, there's one team, they're trying to accomplish something. Everyone has a particular task. Like we've talked about on the cash side, Treasury should own all cash. Otherwise, everyone owns and hoards their own pockets. It becomes very ineffective. That's a massive misuse of the organization's assets. On the risk side, too, if everyone's trying to manage their risk independently, that's a problem. If everyone thinks someone else is managing the risks and nobody is, that's also a problem. So communication, clear division of responsibilities helps to accomplish that. And ongoing communication is part of that, not just here's what we're doing, here's why we're doing it, but people may be seeing things that are happening. Maybe someone notices it's harder to get order. The backlog seems to be growing in certain areas, and that's going to create another risk. So do we have a price risk? Do we need to buy some stuff ahead that may need to bubble up to the organization to say, yes, this is presenting us with a much bigger risk from an operational standpoint than a financial risk. We can't get these materials. Therefore, let's say our cars are sitting idly because we don't have the chips. So we can make all the cars we want, but they won't get off the lot because we're missing this key piece. And that, it always makes me think of that old war poem, for want of a nail, the shoe was lost, for want of a shoe, the horse was lost, the rider was lost, the battle was lost, et cetera. So there's some aspects of that that's not all about financial risk. That is a key part, and that's what the treasurer speaks about. But this communication has to cover and touch on these other areas from an institutional or enterprise level to communicate about what's going on, where are these risks. Can this be solved with a purchasing contract, long-term agreements? Can this be solved with financial instruments, putting in place some natural hedge? So communication helps everyone, continue to advance from their own area of expertise and knowledge, but learning a little bit more about others. So that's how I'd explain that.
That was a terrific analysis, Craig. A big thank you to you and to our CTM audience for joining us on the edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.